Right. Well, welcome everybody. Thank you for joining our first retirement plan participant virtual town hall. Very excited to get this started this evening. My name is Brian Graff with Conrad Siegel. I am the employee communications specialist and also an investment advisor representative for Conrad Siegel. As I was watching a lot of the registrations roll in, there were some familiar names out there, some people I've luckily got to meet over the years and get to know a little bit as we've been on this retirement journey together. A lot of names that were not familiar to me. So hopefully at some point in time in the future, after our webinar tonight, you do reach out to me and we get that relationship started. So it's what I really love to do. And I hope to talk to you all one-on-one in the future. Today we are doing, again, our first virtual town hall via Zoom webinar. And everybody probably has heard this a million times already over the last year, but being a webinar, I just want to remind you that while everybody can hopefully see and hear us this evening, all of your cameras are automatically turned off, your microphones are muted, so we cannot see or hear you. So no worries if you're in your pajamas, relaxing at home, watching today's webcast. However, because this is a virtual town hall, we want you to be involved. We want to hear from you. We want your questions. So please use the chat feature that's available through the Zoom menu bar. I think for most people, it's probably at the bottom of your screen. Somewhere on your screen, you should be able to locate that and just use chat. Ask questions now, in the middle, or at the end of our presentation. We will do our very best to get to all of your questions. If they went unanswered, please follow up with us after the event, and we will definitely make sure to answer your question at that later point in time. All right, well, I am lucky enough to be joined today by Dave Lytle. Dave is a partner at Conrad Siegel and is also our Chief Investment Officer. Welcome, Dave. Thanks for spending some time with us tonight.
Thanks for the invitation, Brian.
Absolutely. And also with me is Zach Klein. Zach is a member of our communications team, and he has graciously accepted the position of fielding your questions and kind of keeping Dave and I on track during our conversation to make sure all those great questions get answered. Okay, so format for this evening, what we're going to do is Dave and I are going to have a little conversation. We're going to talk about the stock market, what's going on now, how we kind of got here, and we'll answer questions as they come up. Once we're done with that, I am going to just go over some retirement plan and financial tips as we close out the presentation. So, stay active. Let's get lots of good questions. And without further ado, we're going to jump right into it. So, Dave, buddy, friend, how do we get here? What's going on? I guess before we talk about what the market's doing right now, let's go in that time machine, not too far back. What may feel like we're a long time ago, though, for most of us, February 2020, the COVID-19 was just kind of getting in the news. What was going on at that point in the stock market and what happened shortly thereafter?
Sure. Yeah, it's hard to believe, but we've been living in our current, COVID impacted state for over a year now. So when you see your 331 statements come out, you're actually going to be all in the post-COVID time period. So I'm actually going to share my screen. We're going to go back to February of 2020, kind of show what's kind of taken place over that time period. And there's a couple of very distinct periods or trends that kind of flow through. So we'll talk through that. And then at the end, we can kind of move on to more recent, just what happened in the past 3 months. But it's been a pretty remarkable 12, 13-month period in a lot of ways. So it's certainly a good thing to take a look at. So taking a look here, we have a graph that shows you the performance of a couple of different indices. Try to go very high level, just a couple of big groups. So we have US bonds, we use the aggregate bond index, the US large cap stocks, so that's the S&P 500. If you watch any market type news or read the newspaper, that one's quoted a lot as kind of a proxy for what's going on in the US. Smaller US stocks by the Russell 2000, and non-US stocks, so everything outside of the US, developed, emerging markets. We use this index called the MSCI All Country World ex-US. So starting back at February 1st, 2020, as Brian said, COVID was in the news, but at that point, really didn't know much about it, the characteristics of the disease itself, and it was pretty isolated. It wasn't taking place all over the world yet. And February went on, that trend kind of continued. Then really late February, the 19th or 20th of February, that changed. The market went from being kind of neutral to being very concerned. The more was known about the disease and it started to have spreading and growth in more places around the world. So from February 20th to really March 23rd, we saw a very strong sell-off in the stock markets, over 30% in these indices in that really 1 month time period. So very swift and very fast down. At that point, the market really turned around, and it turned around quickly. And it was very interesting because the economic impact and the pandemic impact didn't pivot on this date. But some action was taken by the Federal Reserve. There's some stimulus started going through Congress getting passed, and the markets really turned around. And even in that turnaround, we've seen a bunch of different trends. At first, the big stocks were doing well. So they call them the work from home stocks. So the Google, the Amazon, all those things that we were already using but became that much more dependent on in the midst of a pandemic really did well. Then as more time goes on, more stimulus is passed. We've got some good news on vaccines being approved and the economy started to reopen. Then all of a sudden you'll see smaller stocks, which is that dark line, those took off. Now they're doing even better. And so through this time period, it's really been interesting to see now, okay, we're in the midst of a pandemic, but people are adapting and these companies are going to do well. Then, okay, well, these certain industries have been really depressed by this and we're coming to the end of the tunnel, hopefully, and maybe they'll do well. So over this time period, I mean, yes, you had a sell-off and then a recovery, but even that recovery, we see all those different trends. So I think it's been a pretty remarkable year. And I know Brian and I talk a lot, and there's always the question of where's the market going next and what's going to happen. I feel pretty confident saying 2020 is a good example of why that's a dangerous game to guess, because that really sudden, swift sell-off when things were looking really bad. And from a non-market standpoint, they were still looking very concerning. Cases were rising, economics, really restrictions were in place to try to help us from a health standpoint. But the markets were able to look past that and recovered really quick. So it's something we always talk about, having that long-term point of view. And we think when you see dramatic changes and quick changes like this and unpredicted type trends, it really reinforces that philosophy, we think.
Yeah, it was unbelievable to me, Dave, as not coincidentally, that 3 week or so period from February 19th, 20th through middle of March. I mean, you can imagine my phone was ringing off the hook as kind of being on the front line of all the participant questions and asking for investment advice. I've never been busier. And when I told everybody as part of the advice, try not to panic, which we always say. Let's see how things play out a little bit. I never would have imagined the market would come back as quick as it did. Well, I was confident that it would, just based on the experience that I have and looking at historical trends. But boy, it's amazing how much the market reacts to speculation rather than where things are today.
Yep, there's a lot of expectations in there and reality versus expectations, even just the here and now. And along with not timing the markets, always we say something about asset allocation. It's so much about asset allocation where, yeah, the markets are doing great. And for a while, if you were in 100% equity, you had the largest returns. But if the market turns and you said, I can't take this risk, and you try to change the midst of that downfall, that's kind of a long-term impact on your portfolio. So we always talk about asset allocation. It's that, yes, there's always the idea of if you have more equity in there, the expected return might be higher, but you need to have something in your portfolio that you can be comfortable weathering the downturn into. So we think that's a big thing that kind of came out with that. Like you said, like sticking to your long-term plan, being willing to rebalance, and being comfortable in the amount of risk in your portfolio.
Yeah, Dave, and I'm glad you brought that up too, because when we talk about the more conservative part of a retirement portfolio, usually with Conrad Siegel, that's bonds and bond funds. And while we're talking about that, there's a lot of fear that interest rates are going to start to rise, right? Which is going to typically, I assume, is a negative effect on bonds. And if we feel like that's inevitable and it's coming, again, why should we put money or some of our retirement investments in bond funds if we feel like if we're headed for inflation or a rising interest rate environment?
Yeah, absolutely. Bonds have been in the news a lot lately. And
Yeah.
actually, when you look at this graphic, bonds continue to, well, first, there's an inverse relationship between interest rates and bond prices. So when interest rates go up, bond prices go down. Easy way to think about this is if you have a bond that's paying you 2% and you buy it, and if you own that and say it costs $100, well, may say a year from now, bonds are now paying 4%. Well, if you want to sell that bond you own that's only paying 2%, well, that's not as appealing to people. Why do I want a bond that's only paying 2%? So you have to sell it at a discount to effectively exchange it for cash.
Yeah.
So
Yeah.
the relationship holds that when bond prices are going to go down, when interest rates go up. We actually didn't see interest rates go up till August. So the bonds market was on the same page of like this quick recovery that we were seeing from the equities. And there was also some action taken by the stimulus and by with the Fed to impact the interest rates a little bit. But you're right, from August forward, we're seeing interest rates move up. And actually the first 3 months this year, they moved up significantly. We saw some real losses in bond portfolios. But we still think there's a lot of value to them just because there's the diversification element to them, where when stocks are really at their worst, which you'll see on this page, which is late February to March, that light blue line is bonds. At the worst, it was down just a couple percent compared to the 30 of the stock market. So you want in there for really, you can think of it as a break, both in good and bad times. When things are going up really quickly, it'll hold you back a little, which can be frustrating. But then when things are dropping quickly, it has the other benefit and doesn't let you fall as far and as fast. And why we think those negative rates are going up and no one likes seeing negative returns in their bond portfolio, it's also not good as a long-term investor to only be getting paid 1.5% on the aggregate bond index.
Absolutely.
So short-term pain and interest rates going up, absolutely, it's tough, but an important part of the portfolio in the long term, we don't want rates to be really volatile and spike and jump. That trend of increasing rates is actually going to be good for us investors in the long run, in my opinion, because you want to have some higher returns from bonds because there's inflation and you just as a part of your portfolio, getting a higher coupon payment out of those bonds is going to be beneficial.
Excellent. Yeah, thanks, Dave, a lot. I appreciate that. Put some perspective in there too, because even when I'm talking to younger investors at maybe 21 years of age, planning on working until 70, like why wouldn't I be 100% stocks? If they're really truly risk takers and they're aggressive and they believe in that, that's okay. But usually even with those investors, I like to recommend sprinkling a little bit of bonds in that portfolio. And I appreciate you putting some clarity to why I would even do that. One other thing I wanted to talk about, Zach, maybe then we'll open it up for questions, is somewhere in these squiggly lines in this time period, there was a little event called, presidential election. And other than, when COVID first hit, that this is the second probably most my phones ever were blowing up in my 20 years of Conrad Siegel was this election, because we're not going to get political today, but it was polarizing, right? And people were really worried that whoever would take control of the White House and the Senate was going to have this huge impact on their retirement account, and I don't think we necessarily saw that. Is that pretty accurate, Dave? The election kind of came and went, and to this point, we're not seeing a lot of ramifications of that.
It certainly has impacts. The legislation that came through and the different policies and what they want to try to accomplish is going to go through the market. But the big thing we always talk about is, it's very easy to let your political feelings and what you think is the right way for the country to head to move into your financial decisions and really your investment strategy. And while it's very difficult, we think it's important to keep those separate. And if you do look at the really political impact, you need to say, how's it going to impact the market and growth, not how do I feel about the person in the office or the really direction they're trying to take the country. You can just look at our past two presidents to really see that. When Donald Trump took office, a lot of people said, this is going to be absolutely awful. I'm not supporting this president. The market really responded well to when President Trump came into office.
Sure.
Pro-business, there was tax cuts, a lot of different things came together. I mean, there was non-political factors that often move the market more than actual the politics do. Market went up. Some people felt the same way when President Biden came into office, that, things were the market was doing well under President Trump in that direction. This is a change, I don't like this president. I think it's going to impact the markets in negative way. Since then, the vaccine rollout really took off. That helped markets. There's been more stimulus. There's been talks of an infrastructure plan, and whether or not you think that these are things our country should be doing, yes or no, or how we pay for them, they're stimulating economic activity and the market's really responding. So everyone has political feelings, and it's very tough sometimes to separate them from the financial decisions, but we really believe that's what you have to try to do.
Yeah, appreciate that, Dave. I think that'll probably help a lot of people hearing that. Even though the election's passed, it's going to come up in just a few more years too. So something to think about over the long term with your retirement investments. Good time to probably pause and go to Zach. Hey, Zach, have we got any questions that have come in from the audience?
Yeah, we're getting some good questions in here, and just a reminder for everyone else out there, feel free to use that chat to send in any questions you have about what Dave and Brian are talking about, any personal situations or questions that you have. But one that just came in, Brian said, we're about 7 years from retirement, and we're very concerned about the current stock market bubble. How do we make adjustments to prepare for retirement and protect our investments?
Yeah, so my advice, and I'll turn it over to Dave to get his thoughts as well, is have that conversation one-on-one with an investment professional. Give me a call. I would love to look at your retirement account that's managed by Conrad Siegel. We can kind of see how you're invested and to see if we might need to make some necessary tweaks to maybe scale back your risk a little bit to a level you're more comfortable with. One thing I always like to tell investors, though, is remember that even though you may be a few years or 7 years or so away from retirement, hopefully you want this money to last you, not just up till your retirement age, but 10, 20, 30 years into retirement. So I still think of retirement investing as a long-term proposition, right? Where you need to still take some risk, be diversified, knowing that you want this money to be invested and last you for many years outside of retirement. But definitely, I wouldn't say just don't think about it. Just let it go. We'll see where things are in 5 years. Have that conversation with your investment professional. Make sure you're comfortable with the risk you're taking within the portfolio. You're diversified so that your money's spread out and not hit too hard by one particular segment. And let's just see where things are and keep in touch over those years. Dave, is there anything you'd like to add to that?
And I think you hit on the two things. I said asset allocation is really big to understand the risk you do have in your portfolio. And like you said, Brian, time horizon. You're switching from being a saver to withdrawing funds, but how big are your withdrawals going to be? How long do they have to last? Like getting that perspective will help you kind of evaluate whether your portfolio is in the right place or need to make some adjustments to really switch gears and change stages in your life.
Yeah, absolutely. And even sometimes small changes. I mean, the key as an investor is to not only make sure you're doing the right thing, but that peace of mind. And if it makes you feel just a little bit better about reducing your stock portion of your portfolio, 10, 15, 20%, let's talk about that. So again, I usually don't tell somebody just don't do anything, but let's just make sure whatever you do before you jump in is in your best long-term interest. But thanks, Zach. What else we got out there?
Yeah, I'm going to jump over. We got a bunch of questions as people were joining in, and
Okay.
some ahead of registration as well. So this is probably a good question for Dave. Dave, we said, and you talked about this a little bit, but with everything that happened last year and what the market has been doing early this year, is it reasonable to think that we're heading towards a major correction or a recession?
So there's certainly a lot of fears out there when you said you saw the markets really take off with maybe the economic data not there to support it. Companies' prices are very elevated compared to maybe pre-pandemic, and you could say they're not in as good a shape. The one theme I'm a big fan of is the idea that people are kind of pulling future results forward. So they're saying, okay, we're looking past the current data because we know it's bad for a reason. We're going to look to what we think is the future and back to normal. So I think there's a lot of action taken to support the economy and give it a lot of fuel to grow further. I think there's concerns of will run too hot and have some long-term damage, but I think it might be fair to expect that maybe returns would be muted some going forward because we've pulled some of that forward to the current day. Obviously, there's always a risk of a correction if things get overvalued, and that can be healthy. But currently, some folks are talking about how long this expansion can last, given kind of how we came into it. But there hasn't been that much concern out there of a strong reversal back the other direction. And obviously, no one has a crystal ball. Hopefully, we're getting past COVID, but we're still working towards that. So nothing's ever guaranteed or for certain. But right now, it's just more the question of what are the expectations of returns going forward? And I think a little bit muted is a reasonable expectation, but hopefully not that swift reversal that some people are concerned about.
Awesome. Thanks, Dave. Brian, do we have time for one more here?
Absolutely. Yeah.
Cool. So there's definitely a theme in the questions that are coming in, and we've got a bunch of questions surrounding the idea of like, hey, I'm 40 years old, I'm 50 years old, and I haven't saved a lot for retirement to this point. What do you suggest for the people maybe a little bit towards the middle, later in their career that haven't saved a ton for retirement to this point?
Sure. Well, yeah, one of the popular benchmarks that we use, Conrad Siegel, when we provide education, is that 15% savings goal. So we tell a lot of individuals, if you can strive to save 15% of your annual gross pay, which includes any employer contributions, if your company is currently making contributions in your retirement account on your behalf, 15% is a really great general number. Now, we do say that is really meant for somebody just kind of starting out their career, maybe in their 20s, certainly not much past their early 30s. If they could save 15% from then till retirement age, they're probably going to have a very good chance of retiring comfortably. For those that are in their more the middle of their career, around age 40, I mean, if you can save more, obviously better. Nobody's ever come to me at 65 and said, "Darn it, Brian, I saved too much. I wish I would have saved less for retirement." So that number, instead of being 15%, it may be more. It may be that you need to be saving 20, 22% or more to reach your retirement goals. The key is to find that balance. Know what your number is. Work with Conrad Siegel or your another professional to figure out what number you should shoot for in savings. And if you can't get there today because of other budgetary restraints, paying back debt, loans, just do what you can afford, whatever you can reasonably afford today, and then challenge yourself maybe to increase your contributions by 1 or 2% a year until you get to that goal, to that desired number. And it's, again, the 15% is such a general benchmark, but everybody is so individual in determining that number, because we all have a different retirement vision. Some people would love to retire and travel the world. Other people want to retire, pay off their debt, and go fishing on the weekends. And depending what your desired retirement lifestyle looks like is really going to determine how much you need to save, what that pot needs to look like when you hit retirement age. So, unfortunately, there's not a magic number I can just blurt out today during this town hall session, but something we can absolutely work on you with, determining your number, help you, set those goals, and then just kind of gradually get to them as your situation warrants.
Awesome. Thanks, Brian.
Absolutely, Zach. Anything else come through for us? We do have plenty more time.
Yeah, let's keep going. Our chat's going off here. And again, reminder, any questions anybody has, send them through the chat. Let's go here. So an advisor was recommending some plans that guarantee 7% interest, for example, for 10 years or so. What do you think about something like that versus bonds at this point?
Dave, do you want to handle that one?
So I would read the fine print very closely. That's a very high level of return. There's certain contracts out there that can have higher returns, some level of guarantee or downside protection, but there's usually associated fees, contract conditions, and other things that really make the account very different than traditional investment into bonds or equities. So yeah, I mean, the US aggregate bonds paying 1.5% right now. So something that's paying 7%, it tells you it's materially different in a lot of ways. So why that return itself seems very appealing, I would really recommend understanding what it's invested in, what the fees are, and what are the conditions to get that return. Can't really go into much more detail besides that, but I would just recommend to vet it carefully to understand everything that's involved.
Yeah, that's the first thing I thought of too, Dave. That seems like an awfully high guaranteed rate of return. So just be careful before you jump in to a particular investment. Jack, do we have one more we want to handle before we shift gears a little bit?
Yeah, let's go to one more here, just going fresh off the chat. In terms of distribution, what are your thoughts on 4% per year?
Yeah, the 4% rule is commonly used in our industry. It's one that a lot of people subscribe to, that says, if you withdraw 4% of your overall retirement savings each year, that money may last you, I don't know if it's 30 or 25, 30 years in retirement. I would say that it's a great starting point, right? It's a great starting point. Figure out what that 4% may look like in terms of a annual dollar amount, break that into to monthly payments, and see if it works for you. And I would say, though, that the key to spending down your money in retirement is just being flexible. So whether you can only take 4%, that's great if that's all you need. If you're somebody that may need closer to 7 or 8% of that retirement income to really sustain a quality standard of living you're used to, just make sure you're flexible and you can make adjustments along the way. If the stock market has a bad year or two, hopefully maybe you can take less, maybe 2 or 3% that year, and you'll kind of make those little changes along the way. But I look at it as a good starting point. And then you can really take a deeper dive into your own situation and look at Social Security and all that stuff. But it is a good kind of rule of thumb type of benchmark. Dave, what are your thoughts on the 4% rule?
Yeah, I think everything you said makes a lot of sense. And the other thing is it's always about reevaluating. So like you make the 4% rule and you go for a while and you might find, hey, like I don't need this much money. I have other sources. You might think I need a little more, and you can see like, well, can I increase my withdrawal rate and still think I won't outlive my assets? So I think it's a great, like you said, rule of thumb starting point, but reevaluate and always kind of keep tabs as you move forward to do a checkup and see how things stand.
Okay, excellent. Appreciate that, Dave. And yeah, Zach, thanks a lot for fielding all the questions. Do we have some more that we can maybe answer after the webinar? We can send some individual responses out, Zach?
Yep, absolutely. Yeah. So any questions that we don't get to on here, we've got a few more coming in as we speak here, but any more that we don't get to, we'll definitely follow up with you afterwards.
Yeah, and I'll tell you what we can do too. Dave, you got time, right? Zach, you guys have some time. Zach, the Phillies already played and won today, so we don't have to rush off to watch a baseball game. We're in Pennsylvania, so yeah.
That's right.
Phillies fans. Sorry, Dave. Dave favors the western side of the state and the Pirates. We won't get into that. All right, so what we'll do is I'm just going to shift gears a little bit, and I'm going to talk about retirement, some retirement related topics, spring cleaning your finances and retirement savings. And then that's only going to take a few minutes, but let's go back and spend maybe 5 more minutes answering some questions that came through before we wrap things up. Does that sound good, everybody? All right, excellent. All right, so let me go ahead and share my screen. Now, as Conrad Siegel retirement plan participants, hopefully you already recently received or soon will be receiving your quarterly statements in the mail or via electronic delivery if you so chose. But the article we featured this quarter was how to spring clean your finances and retirement savings. So, spring is in the air, and if you're like me, you've got a list this big of things you want to accomplish in the spring. And mine was created by my lovely wife, so I hope I'll probably get about this much of it done. But you got to aim high, and some of the things on that list include cleaning out the garage, going through my clothes that don't fit me anymore from the winter because of the COVID-15 or whatever I put on, cleaning out the closets. We have all these chores we're doing at home. Not a bad time to take this fresh look at your finances and your retirement savings as well. So in that article that went along with your statements, a couple of things we mentioned that you can do. First one being to dust off your profile. So whether it's at our website, which is myconradsiegel.com, or other important financial sites that you have, maybe go in and just take a look at your profile. Do we still have the latest and greatest email address on record for you? Has it been a while since you've changed your password, or do you need to reevaluate your security questions? It's spring. Why not take a look at your profile and dust off some of that information? The second tip we gave you this spring is to really take financial inventory. It's really easy to sit here and say, hey, let's everybody save 15% of their salary towards retirement. But if you don't have a budget in place, if you don't have track of the money you have coming in and going out every month, that's really hard to do. And, I am surprised how many people that I talk to on a daily basis that will admit to me and say, Brian, I really don't have any budget at all. I'm just kind of winging it month to month. And, so I definitely recommend, if you don't have a budget, set one up. You can use some of the tools on Conrad Siegel's website. You can go to our Financial Wellness Center and use some of the planners we have available to take inventory of what's coming in and what's going out every month. And once you have that peace of mind that you really you're accountable for everything, it will help you create a plan for spending and saving going forward. So make sure you take financial inventory. The third thing we mentioned here is declutter your accounts. I get a lot of calls from people that say, Ryan, I've got my 401k plan or my 457B through Conrad Siegel. I've got this rollover here at Fidelity from my first job, and I still have money at Vanguard from my last employer's account, and I'm just kind of losing track of it. What should I do? Not a bad idea to consider rolling your money into your plan through Conrad Siegel. We can talk about your situation, go over some pros and cons of doing that. But generally speaking, by rolling money into one account, again, you can get rid of all the statements from your other companies, get everything in one place where you feel like you maybe have better control or just better grasp on exactly what you have saved. So rolling money from other accounts into one account is sometimes provides people with a lot of peace of mind and just knowing everything's in one place and they're being well taken care of. Next tip is to refresh your beneficiary information. Now, remember, your beneficiary is really the person who is entitled to your account balance if you pass away with money in your account. Not something we love to think about, right? Our own mortality, but it is super important. The last thing that you would want when you pass away is for this money to go to an ex-spouse, right? Or maybe somebody that you've kind of had a falling out with over the last 20 years, but you just forgot to change your beneficiary. So it's always a good idea, periodically just to remember, who is my beneficiary I designated on this retirement plan account? Who should it be, and do I need to make those adjustments? So remember who your beneficiary is and make changes when necessary. Clean up paperwork. So are you tired of getting all those statements in the mail from Conrad Siegel and throwing them into a folder or a desk drawer, and now maybe you've got all this clutter around the house? One thing you can certainly do, and we're recommending that everybody does, is to go out to our website, go to myconradsiegel.com, go into your communication preferences under your profile, and sign up for e-delivery. We'll make sure that your historical statements are always available for you. You can always call us if you want a statement for a particular quarter, but rather than, all this paper sitting all around your house, sign up for e-delivery and get that all in a nice electronic format for yourself. And the last tip we're going to leave you with, something to think about this spring, is it's a great time to replenish your emergency fund. Okay, so if COVID-19, if what we've been going through over the last year has been rough on you financially, but maybe hopefully now you're starting to kind of get uncovered a little bit. Things are starting to look up. Maybe start replenishing your emergency fund that you've depleted over the years. So start small, put a little bit in, and gradually build up. Eventually, boy, it'd be wonderful to have about 3 to 6 months worth of expenses saved in your emergency fund, to be prepared for the unexpected. But starting small is great. Maybe put $20 a paycheck in, $100 a month, whatever you can afford to get that back to a point where you're comfortable. Okay. And lastly, remember, we truly do value the partnership we have with all of our clients and plan participants. So if you have any questions about your account, about the way you are personally invested, whether it makes sense to roll money into this plan or not, call us. We're only a phone call away, 1-800-577-3675. If your question is specific to investments, ask for Brian. I would love to talk to you. And as I mentioned on the onset of today's meeting, love to get to know you and start that relationship over the years. So we truly want you to be informed about your plan, about the investments. So again, use that phone number, 8 a.m. to 6 p.m. Eastern time, Monday through Friday. We would absolutely love to hear from you. All right, so I'm going to stop sharing my screen, and as I promised, let's spend about another 5 minutes or so, Zach, going through questions we got about the market or whatever's on people's minds today about the retirement plan, and go from there. What else do we got?
Yeah, absolutely. Let's go here, Dave. We got a personal question for you here. And the question is, do you have a favorite index or mutual fund right now, and why?
So I'm going to take this in a little different direction.
Yeah.
But something we do spend a lot of time here on is actually understanding the index you're investing, the underlying benchmark. So a lot of people think, okay, large cap stocks, S&P 500 or Russell 1000. Okay, they're a little bit different. And one change we made in our portfolios a little bit ago was we introduced something called the extended market index to a lot of our funds. So a lot of people think small cap stocks, small cap index should all behave the same. Well, some of them invest in just a certain percentage of the market, and other ones invest in everything that's outside the S&P 500. So I'd say when you're investing in an index fund, in our accounts, we do spend the time to understand what the underlying benchmark is and how it all fits together. If you're investing in accounts outside of the account affiliated with Conrad Siegel, I really encourage you to do the same thing. Even when you get to your foreign stocks, you see EFA a lot. That's developed countries outside of the US. So UK, Europe, Japan, Australia. Emerging markets is Brazil, Russia, India, China. And some are called all country world, which is all those together. So I'd say the one thing to realize is all index funds are not the same. And it gets a little tedious and be a little on the nerdy side, but actually dive into the underlying benchmark to understand what you're getting exposure to. So I think that's something really important to understand what that fund's trying to deliver for you.
Thanks, Dave.
Great, thanks, Dave. Brian, let's go back over to an age-based question. So we're 51, single, no children. What would your advice be for saving for retirement at this point? The question exactly is, do the pennies put aside now really make dollars later?
I would say absolutely. Yeah, it's never too early or too late to start saving for retirement. We recommend that participants save from the time they start their careers till the last day of their work. Especially, I mean, if your employer is making contributions, you definitely want to take advantage of the match if they have a matching contribution. But absolutely, at age 51, like I said earlier, hopefully you live to be, I'm just going to say 91. Does that sound good? So maybe 40 more years where any penny you put in today will get that compound earnings. And as long as you're in a nice, again, diversified portfolio with at least medium risk, I mean, those little pennies today can absolutely make a huge difference, not only when you retire, but during your spend down stages of retirement. You're going to keep gaining interest on top of interest on those dollars. So yeah, certainly don't stop. A lot of the IRS introduced catch-up contributions many years ago, where they allowed participants turning age 50 the opportunity to put even more money into their retirement accounts, thinking that just in case the 30s or 40s weren't optimal savings years for them, this gives them the opportunity to put even more money away, money that they're going to need in the future. So that was probably a long way of answering that very simple question. Yeah, absolutely. A penny today could be worth several dollars tomorrow.
Brian, do you know the Einstein quote about compound interest?
Let me hear it, Dave. I probably heard it.
I pulled it up so I didn't misquote this.
Okay.
Compound interest is the eighth wonder of the world, Einstein reportedly said. He who understands it earns it, he who doesn't pays it. So Einstein was a pretty smart guy, and he was a big fan of the idea of investing early and letting those returns compound and work for you.
There you go. Hey, if Einstein said it, let's I like it, Dave. Thank you for that interjection.
It's pretty good. I'm gonna make that my desktop background here. All right, Brian, let's go one more here. So once we get to retirement, how do we determine what our minimum required distribution is?
Yeah, so if you have money in a retirement account, Conrad Siegel still by the time you retire, as the plan's record keeper, we'll do those calculations for you. It's something I'm sure you can look up online as well. You can Google it, but basically it's based on your account balance at the end of the previous year. And then there's a factor applied. You divide it by whatever the IRS mortality table number is. So the easiest thing to say was contact your provider. Let them run those numbers for you to give you an estimate of what it's going to be. Like I said, you can certainly Google it and look up the mortality table, find out what that factor is that you need to apply to your account balance. But again, it does depend on your age, what you have in your different accounts, and then those formulas get applied.
Awesome. Thanks, Brian.
Oh, yeah, absolutely.
Do we have time for one more?
I sure do. Dave, you still good?
Yep, I am.
Let's go.
Right. Sure.
Let's go one more. So we've talked about kind of later in our careers approaching retirement, and I think you talked about this a little bit before, Brian. But what would you tell the person a little bit earlier in their career, maybe 24 years old, very new to the space of 401ks? How should they be looking at their 401k, and how should they be spreading out their portfolio?
Yeah, well, okay, so for the 24-year-old, we all wish we go back in time and tell our younger versions of ourselves, save now, right? Because just like Dave and Einstein told us, compounding is the key there. So the sooner you start putting your money in, the better off you're going to be because of that compounding, letting that money grow interest upon interest upon interest. So I would go back to that 15% savings benchmark and tell that 24-year-old, like, I know there's a lot going on in life right now. You're just starting out your career, you're looking to buy a home, you're paying back college loans, you're starting a family. I mean, there's so much that we can put our money towards, and it's all important. I'm certainly not saying forget about that other stuff, right? Just to save for retirement, but really challenge yourself to get to that 15% number younger. And the most important thing you can do is to start. You know what I mean? Whether that's 1% a year, 2% a year, 3% a year, start when you're 24. And again, as you get a raise, as your life situations change, keep continually raising that percentage up. Challenge yourself to save more and more over the years. But yeah, I would never tell that 24-year-old, retirement's 40 years away. You got time to wait 10 years to start saving. Start now, start small if you have to, and keep going.
And I would add too, if you're starting out and you're kind of intimidated by the idea of picking your own fund lineup of, I don't know of all these different options and how should I build this? When Conrad Siegel builds a lineup for kind of a participant to come in and pick your investments, we always want to have the tools for people to do it on themselves, but something that's called an easy option or more of a do it for me type fund, where if you don't think you have the expertise or the interest in picking all these investments, there's investment portfolios that you can take a risk quiz and decide where you should be placed. Those are called more of like a target risk element, where they'll tell you the blends of stocks and bonds you should have. And some plans have target retirement dates where you tell them, I want to retire in this date, and they'll take the portfolio for you and change it and run it over time moving towards that date. So I'd say that don't be intimidated by the investment aspect of it. If it's something that you don't have the interest or the comfort level with, there's options in there to, like Brian said, work on the amount that you can save and your future planning, and you can eventually rely on the plan, one of those options, to kind of work for you on the investment side.
Yeah, thanks for bringing that up, Dave. I was focused so much on the savings, I forgot about the investment aspect of it. And we always talk about, hopefully your plan has that easy option. We can help you figure out which one you would best fit into. But I think you'll find that at age 24, all those easy options are geared toward having more of your money in the stock market. The younger we are, the further away from retirement, the more risk we can take typically, unless we're really risk adverse, super nervous. We definitely want to take more risk when we're younger. And then over time, either through just the process of these easy options, the mechanics within, or if we have to pay a little more attention and do it ourselves, as we age, we start eventually over time selling off some of those stocks, putting more into bonds. But certainly at age 24, you want to have more stocks in your portfolio than bonds. I can pretty much feel safe to say that across the board, regardless of your personal risk tolerance, to give yourself the room for that growth and compounding.
Okay. Awesome. Thanks, guys. Really good advice there. Well, I think we hit most of our questions, and like we said before, we can go back through the questions, and anything that we didn't hit tonight, we'll try and follow up with you personally. And Brian, if you want to close us out and just remind folks how they can get in touch with us if we didn't get to their question tonight.
Yeah, so I'm going to go ahead and share my screen one more time here. All right, so to contact us with additional questions, whether it's just about savings, whether it's about investing, whether it's how does my retirement plan work, when can I take a distribution, whatever's on your mind, contact us at 1-800-577-3675. Again, Monday, Friday, 8 a.m. to 6 p.m. If you need assistance after hours, let us know, leave a message. I'll be more than happy to call you back some evening when it's convenient for both of us. But listen, hey, thank you so much, everybody, for joining. This was our first retirement plan participant virtual town hall. We will look to have many more of these in the future. We'll probably change up our topics a little bit from time to time, but so happy that everybody was able to spend some time with us this afternoon. You asked some great questions. We really appreciate that. Dave, Zach, again, thank you guys so much for being a part of this panel and taking time out of your busy schedules to be with us all as well.
No, thanks for the invitation, Brian, and thanks for everyone for attending.
Thanks.
Okay, and this time we'll go ahead and end our session, everybody. Have a great evening, and we'll talk to you very soon.